Kia ora koutou. Welcome to our partners and guests. Thank you for joining us today. My name is Andy O'Hare. I'm Head of Strategy and Financial Solutions at the Centre for Sustainable Finance. We've got a great guest to talk to us today, and I want to get right into it, so I'll be quick in setting the scene for the conversation. So across the globe, countries, albeit to varying degrees, are racing to reduce greenhouse gas emissions. At the same time, governments, businesses and communities are investing in resilience to lessen the impacts of weather events that are increasing in both frequency and severity as a result of human-induced climate change. Meanwhile, financial institutions are working to identify, assess and manage the financial risks these events pose to economic activity and asset values. These challenges are closely interconnected. Yet in her recently published paper, which is titled From Planetary Hazard to Financial Stability, Disentangling Climate Risk and Institutional Responsibility, Lisa Sachs argues that treating them as a single concept of climate risk can obscure the distinct objectives, responsibilities and policy responses that each requires. The result is that action is often slower and less effective than it could be. Lisa is director of the Columbia Center on Sustainable Investment, a center of the Columbia Climate School at Columbia University, associate professor of professional practice at the Columbia Climate School, and director of Columbia's Masters of Science in Climate Finance. She's a globally recognized expert and leading voice on climate finance and sustainable investment and natural resource governance. And I'm very pleased to welcome Lisa to speak with us today. Lisa will begin by talking us through the key findings of her paper, which I would encourage you to read if you haven't. And we'll then discuss what these findings mean for the future of sustainable finance, and in particular, what they might imply for a small, globally connected economy like New Zealand. If questions arise during the presentation or discussion, please submit them using the Q&A function on the webinar platform. We'll look to leave time at the end to address as many as we can. Lisa, it was great to meet in person recently over in a very warm London. Thank you very much for joining us today, and over to you.
Thank you so much. I was going to say the same, that it was so nice to meet you. Although as we were just musing, it was during a London heat wave where it felt a little crazy making that we were all talking about the heat as if it were not predictable that this is where we're heading and this really is the new normal. So anyway, incredibly nice to be with you here. Only thing better would be to be with you in person. But I'm joining you now from Hong Kong, where I'm spending most of the summer in Asia, really trying to learn and get new perspectives here than what I learned from New York. Thank you really for this invitation. I find bringing this clarity to all of us to really be one of the most important things that we can do right now. As I was saying to you before, around the world this week in particular, it feels like we're all experiencing incredibly dangerous hazards, typhoons here in Asia, wildfires. My family was in New York affected by the smoke that added to the heat. And heat waves all throughout Europe, and was learning about the flooding in New Zealand. And this is not unprecedented. I mean, it is unprecedented. It's not unpredicted, and it will be the new normal. And what is exasperating to me is that we know how to decarbonize the world's economy. We know how to stop the rising emissions. And yet we're not oriented toward that in any serious way. And my perception is that it's because we've confused a lot of different concepts and therefore have developed a lot of different tools and approaches that purport to address climate change and climate risk, as you've nicely introduced, but without actually distinguishing what we're trying to achieve. So maybe I'll try to speak to some of those ideas, and then I'm really looking forward to the discussion. The first basic point that I laid out with a few other colleagues about a year before this paper was that we should understand that there are three different types of climate risk, fundamentally, or climate impacts. The one that we think about the most actually is the planetary, the impacts on the planet. And the risks of those rising impacts, which is what we're seeing: heat waves, floods, wildfires, glacial melts, coastal erosion. And these effects are here now. Many of them are actually not even, you couldn't even put a price tag on them. We're losing cultures, we're losing species. These are irreversible effects. So those are the planetary effects of climate change. We put in place a number of different buffers as a society to prevent those types of physical effects from reaching the economy and from affecting the economy. So we build resilience and fiscal transfers and different means of trying to protect those physical impacts from having an economic effect on the economy. And we do that quite successfully. By the way, a lot of these effects are not even in places where they do affect the economy. You can have coastal erosion and species loss in places that don't have right now economic value. So when we talk about the economic losses or the economic risk of climate change, it is already a smaller subset and a delayed subset of those planetary climate risks, partly because, again, some of those impacts are taking place in places or affecting species loss and cultural loss and other even human impacts that we don't attribute a value to, but also because we intentionally buffer the economy from those physical impacts so that we don't experience such profound economic loss every time there's a physical climate event. So the economic costs are already, they're real, they're mounting, but they are already a smaller subset of the physical climate effects, and they're delayed because we put in place intentional buffers and delays, and they're a smaller subset. Then the question is, how much of those economic impacts reach the financial markets? And yet again, we put in place very intentionally and wisely a number of different buffers that prevent economic loss from destabilizing or affecting the financial markets. We protect the financial markets for good reason. That's insurance and reinsurance and disaster relief and income support and reconstruction spending and emergency lending and sovereign buffers, so that the governments can absorb some of these costs before they go to the financial sector. Again, that's all intentional so that when there's an economic loss, it doesn't completely wipe out the financial sector. So again, these are intentional buffers. That means that when banks, for instance, are assessing their financial risk, they're not looking at the risk. They're rightfully not looking at the risk of flooding or of heat waves as the determinant of their own losses. They look at how those impacts transmit through the economy, again, which are buffered, and then their loan portfolio, which is over a set amount of time, how the loan portfolio is likely to be affected. And they anticipate rightfully that there's insurance mechanisms and reconstruction that the government steps in. So from a financial sector perspective, the assessment of risk, which is how we would want them to be accurately assessing risk, is looking at the risk to their financial portfolio because their mandate is to assess their own exposure to financial risk. So financial risk is really the residual risk after these intentional buffers and after the transmission of the physical risk to the economic risk, and only what is not buffered to the financial sector. We should just understand that that's how it works. It's not a value judgment about how it works. It's what the financial sector, it's how they work. Their job is to manage capital. And so to understand how that capital and how their portfolios will be affected. So that is how they look at it. The main point here is to understand that climate risk means different things. It is that the way that the banks experience financial risk shouldn't be the thermometer for what's happening on the planet. It's not. Their assessment is how the financial sector is impacted after the transmission of the very real physical effects that we feel through the economy and through the financial sector. Then the next contribution of this paper is to also explain that there are different important ways to respond to this risk. The most fundamental, to my mind, is reducing the underlying driver of climate change. And there's only one way to do that. That's mitigation. That's decarbonizing the world's economy and decarbonizing the systems that are producing emissions. That is the only response that actually reduces the increasing risk, which we haven't done, even though we know exactly how to do that. We know how to decarbonize energy systems, transport. We know how to decarbonize industry, even if the technology there is still evolving. We know how to decarbonize buildings. We know how to decarbonize the world's economy. We're not doing that, so emissions continue to rise, but that is the only response that reduces the driver. But then there are other important responses for society. Resilience is important when you're experiencing floods and heat and wildfires and glacier melt. How do you prepare and build the ability of society to anticipate and then to absorb those shocks? Insurance, which is spreading the losses so that one impact doesn't wipe out either a household or livelihood or a society. We want our financial system, we want the government, I should say, first to maintain fiscal stability and be able to pay for all of the government services they're meant to be paying for. We want the financial sector to be managing its own exposure to these impacts so that it can preserve the wealth that it manages on behalf of society, or the value, the assets that it manages on behalf of society. And then we want to preserve financial system stability. Those are 6 completely distinct objectives. One of them reduces the underlying driver. 5 of them manage the consequences. All important. And those are allocated to different parts, different institutions in the economy that have mandates and instruments to respond in those different ways. My point in the paper is that we have really profoundly confused these concepts. We've largely collapsed the concept of climate risk as if there's one type of climate risk, that different institutions should be assessing their climate risk. The kind of assumption that underpins that is that if all different institutions, including financial institutions, properly assess climate risk, that we would somehow all orient toward a safe, a decarbonized and resilient future. And that, as I explained in the paper, is wrong for these reasons, but it's also a profoundly dangerous misperception, because actually assessing and managing risk for some of these institutions has the opposite effect, because some of these institutions, their approach to managing risk appropriately is to not be exposed to risk and to withdraw capital or to withdraw exposure to the regions that need investment the most vulnerable communities, or the assets or the sectors that we need to be investing in for resilience or for decarbonization. But the genuinely appropriate way for some financial institutions to respond to risk, insurance, for instance, is to price the risk. When there's higher risk, you price it higher, you don't insure. That's the appropriate thing to do from insurance perspective. It's rational. It's literally what they're designed to do. So there's a danger in the conflation of thinking that if only financial institutions could assess risk and disclose risk, that first of all, when they don't assess risk to be as profound as we're experiencing it, that's not wrong on their part. It's because financial risk is a delayed subset of real physical risk. And then when they do disclose the risk, their response is to price vulnerability higher or to withdraw from vulnerability, which we also are seeing now as a rational response. So the confusion matters a lot. We've built a whole architecture around the idea of assessing entity level risk, of managing entity level risk, of stress testing institutions. My fear, my perception is that we've built a lot of that with the false expectation that doing that is what will lead to a safe, decarbonized future. And it won't. It's not designed to. These are institutions and instruments that don't work. They don't have the capability to do what needs to be done to mitigate climate change, which is to build systems, to build complex clean energy systems, to build interconnected clean transport systems, to build sustainable, clean, resilient cities. Entities are not able to do that on their own. We need to build those systems. We absolutely know how to do that. We know how to build systems, but it has nothing to do with these types of, it's not related to risk management, and it is not driven by the financial sector, and it's not driven by entities, any type of entities acting on their own in response to perceived risk or even with their own targets, because systems require systems to be built. They require coordination they require planning, careful planning on the basis of technical scenarios. They require coordination among a number of different public actors, private actors, not quote unquote policy per se, but really identifying which parts of the public sector are relevant for building systems, the building codes, procurements, mandates, efficiency standards, flexibility in energy systems. There are many different parts of the public sector that have different roles and responsibilities with respect to building these systems. So, that's actually my background, I should say. That's where I come from. I come from all of this by having a decent understanding of how systems work and how we can, and the various drivers, the barriers, the challenges, but also the levers that can build systems and that can help us understand, for instance, why energy systems are not built in emerging and developing countries, even though the case for building clean energy or energy period is so profoundly evident. We still have hundreds of millions of people that don't have access to clean energy. That's a good investment. And the reason it doesn't happen is a function of these structural and systemic barriers and challenges that we're not oriented toward. So that's my basic point in this paper, is that we should be clear on the distinct objectives, that the conflation is very costly for us right now because we're not able to do any of these functions well, certainly not mitigating the underlying drivers, but also not appropriately responding. We're not investing properly in resilience. We're not being thoughtful about insurance and its variety of trade-offs. We're not actually giving the financial sector the right tools to manage their exposure because the tools conflate a lot of different things. So we're not doing a lot of things well. Let me try to relate this to New Zealand, even though I haven't been to New Zealand in a long, long, long time, but let me say what I think is relevant, and then I'm very eager for your impressions and to discuss. New Zealand faces, at least three distinct things, I would say. One is the goal of building a better future for New Zealand, building the better systems, building clean, efficient, value-creating, cost-minimizing systems, energy, the built environment, transport, industry. What does New Zealand's future look like that is a clean, resilient, secure, competitive economy? The most durable investments in a decarbonized future will be the systems that are simply better than their predecessors. And we're already seeing that. Energy systems that are flexible and that are resilient, and that now batteries and storage can actually create value in ways that traditional offtake couldn't, and can reduce the need for additional investment that we see from China, how investing in the future technologies can be incredibly competitive from an economic perspective and create all sorts of new jobs. So what is that future, and how do you attract investment into that sector? That is more doable now than ever before, because the technologies that underpin better systems across the economy are now available. This is not a lack of technology. It's not a lack of capital. It's a lack of the architecture and the enabling framework that attracts that investment. The plans that say, this is what we want our energy system to look like. This is where the generation will be. This is where we anticipate the demand to be. What's the scenario, so that we can understand what aligns with the government policies and priorities. A proper technical plan is probably the most important thing to attract investment. And then understanding what is an enabling context for that. That can be set by, again, not policy per se, but by really understanding what role the public sector plays in creating markets, standards, procurement, the right regulations to enable flexibility, to enable vehicle to grid transmission, what it needs to be enabled by the public sector to attract that investment. And then also facilitating coordination among private sector actors, because some of the greatest innovation is with the private sector working across sectors. My favorite deal is the BYD Octopus deal in the UK that is a vehicle to grid arrangement that brings flexibility and reliability and benefits to the consumers. That's largely a commercial deal, but has to be enabled by the public sector. So what are the coordinations among different private sector actors that, by the way, are not encouraged by entity level thinking? They're encouraged by systems thinking and thinking about what we're trying to achieve. So actually attracting investment into New Zealand's better future, clean, resilient, efficient, value-creating, competitive future is a matter of thinking about what are the systems we're trying to build, technical scenarios, enabling infrastructure, coordination among the real economy actors, and thinking with the financial sector, if there are financial barriers to this, which there can be, what role can the financial sector play in financial structuring, guarantee structures, different types of credit lines, aggregation? That's financial structures that enable real economy. Building the real economy. I really like to focus on that because I think that future is eminently buildable. Then downstream, I would say the resilience and building resilience into the economy, thinking about insurance and its trade-offs, that is largely a public function. The government should be aware that these are mounting costs, resilience is mounting costs, disaster response is mounting, and the government's ability to plan for and to manage those increasing costs and trade-offs that the government has to prepare for. That is no one else's responsibility besides the government. That is largely a public function. And those trade-offs and those costs are mounting in the absence of a clear plan. Then for the financial sector, what I would say with some caution is that as a small country, New Zealand really is a bit at the brunt of the international financial structure and architecture, and the expectation of following kind of the taxonomies and the rules and the standards set by the international community is hard to push back on. And I understand that with regret, because I think we've built a lot of structures that are not fit for purpose. But I encourage all of us to question those really and to engage in collective conversations about whether these taxonomies and the standard setting and all the reporting that we're doing and all of the disclosures are serving their objectives. It's so deeply entrenched. I hear all the time the consequences of any one entity saying, look, these reports are not serving us. We're not going to do that. And then it triggers some falling out of some index that's just passively tracking those who have made these disclosures. It's so deeply entrenched in very, I think, perverse and problematic ways. But this is where I hope we can have a collective conversation about whether these approaches, these tools, these frameworks, which are everywhere around target setting, net zero alignment, disclosure frameworks, taxonomies, green labels, and so on. Are they serving us? Are they serving their purpose? My perception is that there's a lot of doubt below the surface, that a lot of institutions understand that these are not actually fit for purpose, but that it's hard for individual actors, including individual countries, when you're New Zealand, to say, this is not working for us because it's how the rest of the economy works. But this is where I hope that in associations with among the financial sector, with sustainable finance centers, we can have that real reflection about whether this is serving all of our purposes, and if not, how we can adjust. So maybe, Andy, I will pause there, stop there, and hope that that is good food for thought, and looking forward to your thoughts and reflections and others too.
Great. Thanks, Lisa. Absolutely loads in there to pick up on. I think that's really useful. I think just picking up on a couple of bits. So thank you kind of for, I guess, kind of transposing some of your thoughts onto New Zealand and what it means for New Zealand. I think definitely in terms of your comments on what does the future of New Zealand look like, a prosperous New Zealand, and kind of long-term planning. And Definitely something we've been advocating for around energy strategy, industrial strategy, how the long-term plan and the associated investment signals are very, very important from a capital attraction perspective. So yeah, really good to hear that. And I think that, yeah, there's something to learn there and it probably differs across different jurisdictions, but there still needs to be clarity on the role the public sector has to play in kind of within those plans, right? So setting those plans, but then within those plans. So it's so great to hear that. And also, yeah, on resilience, again, clarity on role of government, it comes down to those difficult choices between who pays and how you achieve this, right? And my own view is, there's for resilience investment, it's kind of, at the end of the day, it's the public paying. It's kind of how you achieve it and who within the public pays for what and how you understand who benefits and what the fair allocation of payment is. So on the paper and on your thoughts on the paper, look, really useful to hear your sound bites. Like, as I would say though, it's a great paper, really thought provoking. I would encourage people to go and read it, especially. I really like the visualization of the kind of the risks and how they interplay with the buffers that you mentioned and that kind of thing. Bring that to life. So it's really, really useful. So if we jump into a little bit of Q&A, I've got some questions. We've had some pre-submitted questions and a couple of questions coming in on the Q&A. So I'll look to cover what I can. And as I say, if anyone has a question, please use the Q&A function. So I wanted to start on the role of and expectations of financial institutions. So you argued that climate policy is often conflated planetary, economic, and financial risk, leading to expectations, and you kind of set this up really well in the paper, I think, but leading to expectations that institutions should pursue objectives beyond their mandates. And I definitely saw some of this tension myself in London through some of the conversations that I was in. Do you think that, kind of for want of a better phrase, that the current global ESG backlash has made the dynamic around unrealistic expectations more visible? And if so, is it kind of an opportune moment for the sustainable finance community to correct the issues, versus 2 or 3 years ago where maybe it wasn't so visible, it was more difficult conversation to have?
Yes, and yes. I think that this backlash is a result of the confusion, because we have, if I take a step back, my sense is that there was a perception, two things happened at once, at least. There may be others. One is the sense that the financial sector are the stewards of capital. So surely they're the ones that determine where the capital goes. That's not accurate, actually. They finance what's financeable in the real economy. Finance flows. I think of it like water flowing downhill. Finance doesn't determine what should be financed. They finance what's financeable. By the way, that's appropriate. I don't want the financial sector to be determining what should be financed. I want us, a society, to determine what should be financeable, and then finance finances it. So one, I think, fallacy was the idea that as where all the money is what determines what's financed, and that is not largely true. They finance what's financeable in the real economy. The second, I think, confusion was about 10 years ago. I think Mark Carney said climate risk is financial risk. That part's correct for the reasons we said, but the conclusion we drew from it was wrong. The conclusion should have been, so we better mitigate now so that we don't face the profound economic and financial risks down the line, which we still will. But what was taken from that is, if only we can talk in terms of the financial sector's understanding of risk, and that if the financial sector can understand the financial risk of climate change, if they respond to that risk, then they will be responding to climate risk. But that's if A to B doesn't mean that if you address B, you address A. That's a math fallacy in that case. And so we have built the architecture with the tools that we're expecting financial sector to use as this risk perception and risk assessments, but that doesn't lead to real decarbonization. So I think the backlash has been the result of both of those things. It's this sense that if we use these risk tools, disclosures and risk management, which are good, they're good and they're fine. Those shouldn't be political, actually. Risk management shouldn't be political. It's prudent risk management. But it was couching those or covering those in a climate policy frame that allowed it to be political, because then the suggestion that financial institutions manage climate risk felt like a climate policy thing in the US, because we're crazy, that was enough for the backlash, but it was also just the sense of you're not assessing risk enough. And, the fight at the FSB, at the Financial Stability Board about like whether this is really a long-term financial risk. This shouldn't be a fight over policy. It should be a fight over our real appreciation of the risk and the risk to the financial system, which is different. So I think the politicization and the backlash has been a result of this confusion. It's not separate to it. And yes, this is a moment to reevaluate, not only because it's led to all sorts of weird hushing and navigation, and so this isn't serving anyone, but also because it wasn't serving us to begin with. This is a reflection of the fact that we weren't thoughtful about it to begin with. Maybe the one point that I feel the need to say is this is not saying that the financial sector is a passive, should do nothing. I'm not suggesting that. They are an engaged and powerful actor in our society the way that other large, engaged, powerful actors are. So what I would say the financial sector could and should do is, first of all, understand what is already financeable in the real economy, because a lot of better systems are already financeable, but because they're non-traditional, they're not financed. The second I would say is that a lot of what it should be financeable is not because the structures don't align, because they're first of a kind risks, or because there are misallocated risks in general. What can the financial sector do in partnership with guarantee companies, or with development finance institutions, or with export finance institutions, or just even within their own financial institution, to create different types of financial structures that reallocate that risk and make better systems financeable on their own? And then the third is these financial institutions understand what makes things financeable in the real economy. Let's engage them in making the real economy financeable. How do you make energy systems financeable? How do we think about proper planning, integration of data centers into energy systems that builds capacity, builds flexibility, rather than stresses the systems? I think that the financial sector should help us deeply engage in how to make systems financeable, what can be targeted roles of the public sector, what's enabling. We can learn and engage with them, but not expect them to drive it. So it's not to say the financial sector should not have any role. To the contrary, let's engage them constructively. Manage the risk. To me, that's an imperative, but it has nothing to do with the world that we want to live in. They should manage the risk so that they're managing risk. But building the world that we want to live in, that's where we should help them think about what's already financeable, what could be financeable, and how do we make the rest of it financeable. To me, that's the role of the financial sector.
Okay, and so who do you think, in a perfect world, who would kind of pick up your paper and read your paper and kind of take the key points from your paper?
Yeah, good question. Good question. And I'm trying to figure that out too. I've been reframing this concept of political will, because I hear it all the time, to this concept of public will, because I think if more of us were just clear-headed on these objectives and what we're trying to achieve, that all of us could be having clearer conversations in respective ways, because it's a very good question, because it's in some ways so deeply entrenched that it's hard to figure out which string to pull. My hope is that with clarity of objective, clarity of levers, that all of us actually in our respective roles, if you're a policymaker, you can think about what is the respective role of policy. If you're in a private sector, you can think, oh, what could I do that is more engaging with the systems view? If you're the financial sector, and I talk to the financial sector all the time, I am encouraging the financial sector to help us engage in those solutions-oriented conversations. And hopefully the more that we do, the better. The less, maybe, the less entrenchment the prior nonsensical system will have, because we can just focus on the system. So that's my hope, actually, is just that as a public, we can better understand, think more about what we're trying to achieve and what achieves those goals, so that we can engage more constructively. And maybe if I can just say one thing about what you said about the role of the public sector, because that's key. I think as we've recognized the limitations of these frameworks, we've put a lot of blame or responsibility on the public sector, and thinking that these initiatives are in lieu of public sector leadership, and that we just need policy to set the framing. And I also don't think that's right. Policy is an equally large, unhelpful umbrella. Governments are also complex. We should be thinking about the risk. Governments and policy are myriad, hundreds of different functions within the government and the public sector that have many different responsibilities. So those of us thinking clear-headedly about what we're trying to achieve, whether it's in building the better systems or whether it's in resilience or whether it's in thinking about the insurance sector and how we want to manage that, whatever the function is, should identify the specific public functions, to your point, not expecting policy to move. But if we want to have, for instance, smart buildings and smart cities, who are the respective government agencies that manage land use and energy systems and the utility and building codes, and engage them in constructive problem solving, not wait for something to come, but how do we engage the relevant public actors in this collective problem solving? That's what and then we don't need to wait on policy, nor do we need to see those systems changes being outside of what we can control. We can engage the right actors in finding these solutions. So we don't need to see anything as a substitute for policy. We need to identify who the right actors are. And in a government like the US, which is off its rocker completely, there are still absolutely a ton of public entities and officials who are deeply engaged in thinking about how to build the better systems and doing a lot of great things at the local level, at the state level, or thinking with the utilities. So let's engage them in the mandates that they have and the tools that they have, and don't need to be so consumed by the insanity at the federal level, I would say.
Okay, so I think because it's election year here, I did have a question coming up about policymakers, but you obviously made a point about policy there. So is the role of the policymakers here then more is around that long-term strategy rather than individual policies that are going to be silver bullets? Is that fair?
I like to look to China, honestly, and what we can learn from China, not from their form of government, but from what they can teach us about the way that they work, which I would say is the following. First of all, the ability to plan, and the ability to plan on the basis of a technical understanding of your economy. So what is your energy plan? Where is the energy going to come from? What is the expected demand? That should be modeled. It should be done. We should have scenarios that can be interrogated. They bake assumptions about technology costs, assumptions about fuel costs, assumptions about demand growth, and that you can play around with those. Those are called sensitivity analyses. What happens if we change these assumptions? That helps you make good, and that helps you understand how the costs are allocated and affordability. So a plan based on an understanding of the intersection of the economy, that I would say is one thing. A second thing is that China holds multiple objectives in view at the same time: energy security, energy efficiency, industrial competitiveness, and more. So how do we, that is a government's role, actually, is to be able to have a coherent understanding of society. I just read their 5-year plan for the agriculture sector, which is mainly about food independence, so that they're not so dependent on imported foods. But you read the plan, and it includes biotechnology and irrigation and water and labor and ecology, because it understands the system. So how do you hold multiple objectives in once? I think that's also the role of the public sector. And then to think about the role that the markets play in that, which China also does. This is not a top-down government. They're not controlling everything. They've determined where the market plays its role. Where can market innovation play its role? And the markets are huge, by the way, and very competitive in China. So they also think about the respective role of the public sector. How can you use the public sector tools that they have and public finance to create an enabling framework for the private sector? We can't all do it as effectively as China does. They do it extremely coherently. But the basic idea, I think, is right. Have a plan, make it a technical plan. Then it can be interrogated. You show that this is in the interest of the public sector. Uruguay actually is a good example of how they did this. In Uruguay, they had a compelling vision for Uruguay that was accepted by across the whole political spectrum, and then think, well, what are the rules that need to be in place to achieve this? How do we finance it? And so on. So that, I think, is the role of public leadership. So you can have this discussion on affordability, on objectives. This is what we're trying to achieve. This is how we're going to get the information. And this is the role of the public sector. This is the role of the private sector. And then in actually delivering that, that's not a top-down thing necessarily. That's really understanding in every sector and every function. They're thinking about the respective capabilities, instruments, tools of different public sector actors and engaging them. But the leadership, if you're in an election year, comes from a leader who understands this role of public leadership, I would say.
Yeah, okay, thanks. I was going to ask where globally you've seen good examples, but you've gone to China. So I thought, well, look, I'll ask you where apart from China. And now you've mentioned Uruguay. So it's like you're one step ahead of me. But
I recommend a very short article. I think it was in the Washington Post. If my memory serves, it was from September 15th of last year. Very short article describing Uruguay's energy system planning. That is an extremely useful description. It's small, literally opposite from China, right? In size and in capabilities in many respects. But it equally, to me, shows how coherent planning can build political will, public support, and a coherent and implementable plan. It's a great case.
Okay, cool. I'll check it out, and probably very relevant for a market like New Zealand, right? And I think that you made the point around bipartisan, right? And it's like that's one of the big stumbling blocks, and so hopefully be able to check out how they achieve that as well. So
exactly.
Okay, so looking at New Zealand, as you appreciate, we're a relatively small capital market with some significant exposure to climate risks and fiscal constraints. Do you have any key messages or actions for New Zealand financial institutions who might be on the call today, and maybe what could or should they do differently, or just be thinking about?
Yeah, so another confusion, if I could even unpack one of the ones in the report, is around this question of resilience and exposure to risk, because we have also talked about we as a society talk about resilience as needing to quote unquote finance or invest in resilience. But resilience itself is a huge category that includes both the physical hardening of specific assets, so making transmission lines more resilient to extreme weather. I'm reading California Burning right now, very good book. Or drought resistant seeds or air conditioning units, or kind of the physical hardening of specific assets, that there's a business case and there are things to do. But then that's different from flood risk management at a societal level, or reef preservation and restoration because of its potential to prevent coastal surges. Those type of landscape resilience is not financeable in normal terms by the private sector because it doesn't generate returns. It avoids future societal losses, which is not a financing model for the financial institutions. So I would say for financial institutions, understanding where there is genuine exposure to physical risk and how through stewardship and engagement and financing decisions we can harden assets that can have some benefits beyond the actual asset, although not always. Sometimes hardening some physical assets just transfers their risk to others that are less prepared. So again, this is to me the role of society, of the public sector, to hold those tensions in view. But where can we build resilience into our economy now? Where is there a good business case for it? And then I would like the financial sector to help engage with clarity around the limitations of what the financial sector can do, or to say, look, our assessments of risk mean that the pricing of risk in this area is going to increase, or our ability to finance is going to increase. Let's have a public conversation about that. There was just not so recent maybe, but a few months ago, a blog from the European Central Bank that said that the developing countries that are not transitioning fast enough and that are most vulnerable, that's because they can't borrow affordably and don't have the fiscal space to invest. But because they're not transitioning fast enough and because they're more vulnerable, they're facing even higher borrowing costs. That's a response to risk and to resilience. So the financial sector, I think, can help bring this clarity with others. I'm here to help so that we can say, this is what we can do. Where can we really understand what we can do to invest in resilience with societal benefits, but where are the limitations of that, where we need society to manage trade-offs and to create the right structures to finance resilience as a public good, even if there's ways for the private sector to finance that, resilience bonds and other types of financial instruments, but to enable resilience financing as a public good. That is the conversation I think we need to have.
Yeah, thanks. I think we're doing a lot of work on resilience at the moment, and completely agree. It's that difficult balance, revenue streams, how you get that,
Exactly.
that kind of mechanism of who pays, and I was at a roundtable in London where the really good soundbite, which was kind of well-crafted regulation, can generate revenue streams to make these things investable from a private sector perspective. And I was like, yeah, it's perfect. Like, and it's really, really clear, coherent way of phrasing it. So that was really useful.
I think that's exactly right. I think that's right. But then just to be clear on the risk is that the more that we talk about everything is financeable by the private sector, because it's the direction we've gone in, nature as an investable asset, resilience as an investable asset, until we do what you said, which I am fully in support of, but until we really properly create the right mechanisms to channel capital into things that should be provisioned as public goods, we are going to be consistently under providing those, because that soundbite is right, but we're not doing that. And so what ends up happening is that we are mainly focused on what is already financeable by the private sector, or letting what is not financeable be underfinanced completely, or talking about insane things like tokenizing nature, or whatever, creating instruments that are just not at all fit for purpose. So the soundbite is right, but then we should understand that that doesn't mean we can't rest on that and say, okay, well, until the public sector creates that, we'll focus on what is already financeable by the private sector. It means no, there is a huge class of financing that's needed, massive, nature, resilience, all sorts of public goods that will consistently be underfinanced by the private sector. So we need to actually engage in what are those mechanisms that enable the private sector to finance what should be provisioned as public goods. That, I think, is a very worthwhile conversation. I think you've given me my next paper topic.
Okay, cool. I've got a couple of questions coming. So one of them is a prevailing narrative here, I think here being New Zealand, is to leave the energy system, transport, etc., to the market. And I think I might have mentioned this when we caught up, that there is a view that leaving something to the market is kind of a win in and of itself. But given that markets are not designed to optimize for a decarbonized world, what would need to change? So government, society, financial or other market interventions. So any thoughts on that?
Yeah, it's an excellent question. I have two basic thoughts. One is there actually is no such thing as a private market that doesn't have some public. Markets are shaped by the public sector, period. They can be shaped by the absence of public leadership, but they're shaped by the signals sent by the public sector in all sorts of ways. So first of all, it's not the absence of public sector, it's how is the public sector shaping the market, first of all. Second of all, I am trying to slog through another paper that I need to finish that explains why thinking about market efficiency theory is not the right way to build systems, because free markets can't actually just they can't build systems. Our traditional economics approach is to think of markets as efficient, and when they're inefficient, we price the externality, we create a natural monopoly, we try to tweak it so that the market becomes more efficient. But the alternative view is that we should plan things as systems, and that systems require a different level of planning and coordination and optimization and public engagement. And I think a decarbonized energy system, for the reasons that are alluded to in the questions, absolutely require that. It is not to say that there's not a role for the public sector. For the private sector, the point is not that this should be publicly financed at all. It's that the public sector can we are trying to create integrated among sectors, integrated among borders. That part, I don't know how relevant in New Zealand, definitely in the rest of the world. Flexible, decentralized, with virtual power pools, digitally optimized energy systems. The market won't create that. It reminds me, my father used to talk about building the highway system in the US, and you don't build a highway system saying, anyone with cement, come pour your road. You have a plan. We'd like to get from east to west. This is within each place. You can figure out exactly the road, but you have a plan, and then you can come fill in the cement. So I think the point is not that there's no role for the private sector. It should be financed by the private sector. That's true of many decarbonized systems: shipping, buildings, transport, industry, energy systems. They should be financed by the private sector, but laying out what that looks like and the role that the markets can play in creating the financeable market, that I think is a function of planning and systems planning.
Okay, thanks. And you mentioned in your opening, you kind of talked about convening, coordinating private sector. And I know I don't know if it's your current, but definitely seen some of your previous work in Asia, and you're in Hong Kong at the moment, that was a really big part of the work you're doing there. So can you kind of talk to I don't know, like how you kind of why and how you see that to be like a crucial part to achieving success here. And I presume it's along that systems thinking line, but it'd be good to kind of maybe bring it to life a little bit from your experience.
Yeah, absolutely. It's literally why I'm here to really understand even more what that can look like. The basic conviction for the past year has been that these are challenges, but also with solutions that can be solved by bringing different actors together. If we want to integrate, again, to give the example I already gave of data centers and digital ecosystems into energy system planning so that the data centers can create anchor demand for new build out of generation, clean generation and transmission and flexible energy systems, that is very doable, but it has to be, it requires the coordination. So in context, we're trying to bring together the data centers that have the information about their own, not only their energy demand, but also their ability to their flexibility capabilities and their timing and so on with the utilities, the energy system planners, the financial sector, and treat this like a problem that we're solving together so that we can, if you can bring different actors together around these challenges, they require that type of constructive problem solving. I think one thing that I'm recognizing a bit more while here is the importance of being oriented toward the what's possible, and that actually thinking about what's possible and what we're trying to achieve is the part that we don't often have in view, because entities are used to optimizing within the system as they find it. And we don't often think, well, what could be built? What are we actually trying to build? What is an optimized energy system? What is an optimized industrial decarbonization project? For me, also, it's how do we make sure that we're building these systems in emerging markets? That's part of what we're trying to achieve, that a lot of our systems and our coordination don't achieve because they don't even keep that in view and what the structural barriers are. So I think that's my most recent learning from this week, is that these should be facilitated on the basis of what are the outcomes we're actually trying to achieve. The better systems across sectors, across geographies, and all over the world. Do we know what that looks like? And on that basis, we can and should necessarily be engaging with the actors that shape that system. For emerging markets, it's also the international financial institutions and the credit rating agencies and all aspects of what prevents finance from flowing into emerging markets, which is not a climate story. That's a long-time international finance story. So when we understand what we're trying to achieve, we can identify who should be in the room, what are the barriers, what are the levers, and solve this constructively. So I genuinely believe, and by the way, I think that that's very engaging. I find that when we do that, there's enthusiasm and engagement around that because everyone recognizes this is a collective problem to solve. It's not something that we can do. Whereas I find what's being asked right now of entities and financial institutions to be like pushing water uphill. I keep thinking like the water doesn't flow uphill, but engage the actors in what we're trying to achieve and what enables it and what can we do constructively. That's actually problem solving that a lot of people enjoy. So that's my lesson learned, is which of our institutions, and we're trying to do this at CCSI too, can hold that outcome in view. What are we trying to achieve? What are the better systems, better across objectives, better around the world, across different sectors? What are we trying to achieve? What are the challenges? What are the barriers? What are the levers? Who should be in the room? And how do we treat this like a good solvable problem, which it is, and achieve those better outcomes? So it's what we're trying to do, and would love to work with all of you to do that even more across geographies and sectors and the challenges we're facing.
Thanks. We're definitely looking at some, work, like what should the sustainable finance ecosystem look like for New Zealand, in the short, medium, and long term, and definitely some useful bits in there. I think we've probably got time for one more, and it's not an easy one. I'll just warn you before I read it out. It's quite a long one as well. So if someone wanting to focus on time horizons, they say that your paper says that because investors value near-term cash flows more heavily than distant ones, even large expected future losses have limited effect on asset valuations today. This reflects standard financial logic. Do you see us as a society globally being able to address planetary risk while investors value near-term cash flows more heavily than distant ones? Or do we need investors to take a long-term view and care about planetary risk? So they say, in short, I'm curious about your thoughts on how to address the tragedy of the time horizon. Who's responsible for taking a long-term view?
No, it's a great question. You're right that it's not easy, but it is also the right question. I think that there's a tension in this field between whether we're going to change the way that finance works or whether we can make the world financeable. I don't love the way that finance works necessarily, but I find it a much more practical approach right now to understand how finance works and to make the world financeable rather than to try to change the values of finance. Finance are held, and by the way, as myself, I have a 401k or whatever, and we're all invested in the financial markets. We also care about those long-term returns. It's not to hold a long-term in view is actually, that doesn't help so much, actually. Let me give two examples. One is that because I think that with the climate lens, we've kind of confused what we expect of the financial sector. This is not a time horizon thing, but it has a similar point, which is that the pandemic, COVID, or other types of pandemics present systemic risks. But if we pushed the financial sector to understand, shouldn't they understand the pandemic as a systemic risk? Sure, but that doesn't mean that the financial sector has the tools to build public health systems, to engage community health workers and think about the roles of hospitals and prevention and preventative healthcare and managing cross-border transactions because pandemics are cross-border. So appreciating a risk and holding a long-term view doesn't mean that the institutions we want to hold that risk have the instruments and the tools and the mandate and the capabilities to build the institutions that would avoid that long-term future. Same with inequality. Inequality is a massive long-term risk. We can appreciate war is a long-term risk, but we don't expect that if financial institutions understand that risk, that they have the capabilities to invest or to change the outcome. But somehow we have expected in climate like they would do that. That's one point. The second point is, even when they have that, actually, it's a related point, but I'll give a very concrete example, which is the Norges investment bank, one of the largest public pension funds in the world, that is actually a responsible steward more than they pride themselves. Their identity is to be a responsible steward of capital. They put out a report about a year and a half ago that said that their long-term exposure to risk in the US put their portfolio value at that they expected 19% loss of their portfolio value in the US. I might be getting that not exactly right, but I know the 19% figure loss is right. It was in something like March 2025 that they put this out. And when asked whether that means that they were going to change the way they invest to avoid that loss, their response was, no, we can't. That's not our mandate. We finance what's already financeable in the world. We can't change what is financeable. It doesn't mean that they can all of a sudden invest in things that are not financeable or create these systems. So the point there is that even having a longer term risk or even seeing the future losses doesn't mean I guess it's the same point, but it's putting it in a real context. So my view is it's not helpful to insist that they take a longer view and that they see the risk down the road. It still doesn't give them, the financial sector, the instruments to build the systems to avoid it. But if we could take all that energy of insisting on taking a long-term view and focus on what can be done today to make the better systems financeable, because we have the capital and we have the technology and we know the know-how, we can avoid that long-term future where we're ultimately headed. That's precisely the frustration and the point of the paper, which is that to push on taking the long-term view is neither practical, because it's not how finance works, nor helpful, because even if they do appreciate the long-term risk, it doesn't give them the instruments or the mandate or the capabilities to build the systems today to avoid that long-term risk. So I hope that that's a somewhat clear answer. This is not to let financial institutions off the hook. It's to be clear about what finance does and what they're capable of doing, and that we could be building the systems today to avoid that future that we keep insisting the financial sector should understand. Let's not have that long-term risk by building the better systems today, using the tools that we have today to create better systems that are cleaner systems. And the finance sector will engage. They will engage and they will finance that. If we make these systems financeable today, then they will finance that today. So I want to make it a today's solution to avoid that long-term future risk.
Thanks, Lisa. Yeah, completely agree. The finance sector will finance whatever is financeable, right? So I completely agree. Yeah.
Exactly.
Unfortunately, that's all we have time for today. Thank you again, Lisa, for your time, for your passion on the subject, and for sharing your insights with us. We know how important it is to bring international perspectives and practical insights to New Zealand's sustainable finance conversation, helping to ensure that we stay connected to global developments while responding to the realities of the New Zealand market. I'd also encourage you all to check out Lisa on Akshat Rathi's podcast Zero by Bloomberg. Your comments on Mark Carney reminded me of that. And thanks again, Lisa. It was great to hear from you.
Thanks so much, Andy. Look forward to more discussion.
Yeah, great, thanks. Our next webinars are on screen now. To register, please access the handouts section of the webinar platform on the right-hand side of your screen. We look forward to speaking with you all again soon. Thank you.